Ladies and gentlemen, we're so glad you all came to meet with us today. For anybody here, who is this? This is your first Woodlands Business Summit. Oh, all of you, that's fantastic. We're really glad to see that. It's mine too, it's weird. All right, so we're gonna go ahead and introduce Angela Strong. Angela Strong is a certified public accountant, graduate of Texas A&M University. Woo! And a resident of the active community leader in the Woodlands. She graduated in 2003 with a Bachelor of Science degree in accounting with a Master's of Science degree in taxation. She began her career with PricewaterhouseCoopers, LLP in Dallas, before moving to the Woodlands in 2005, where she worked for UHY Advisors, LLP. In 2008, Angela started her own accounting practice, which has continued to grow under her leadership. Angela's experience includes providing tax advice, compliance, and consulting, including entity structure and planning for businesses and individual clients. She also has the experience in managing complex individual, partnership, corporate, estate, fiduciary, gift, and not-for-profit tax returns, as well as managing audit, review, and compilation engagement. Yeah, I think I got that right. Where's your part this morning? I haven't had enough coffee this evening.
Yes.
So with that, Angela, take it away.
Thank you very much. That was an excellent introduction, but I'm going to just kind of leapfrog off onto the next slide if it works. Am I too far away?
Okay.
It's not working. All right, who we are. That was a great introduction, and now we'll talk a little bit about our firm. We have 6 CPAs in our office, and we're a full-service accounting firm. So we do everything from tax filings, compilations, reviews, audits, bookkeeping, payroll services, and everything you could think of relating to accounting. And was that you or me? I think it's me. It's working.
Yeah, I'm not touching.
Yeah, that was me. So one of the things I like to kind of make sure that when we're talking about what we do and who we are is mention that we are a community-based firm. So we are active in our community. We believe in our community. We believe in the idea of community where we are supporting people in our business community in all walks of life. So if you're just starting a business, we're here to help you. Or if you're selling a business that you've grown into something much larger than when you started, we're also here to help. And then we kind of like to say that when we're in the community and you're at the grocery store, your kid's soccer game, or you're at your church, you're running into clients or you're running into people that you know that are a part of the community that we all live and work and play in. So we are locally engaged, we're climate attentive, we're intellectually insightful, and we're performance focused. So intellectually insightful, what I would say is most of the people that we hire come from Big Four accounting firms with solid backgrounds in accounting, where they have a lot of experience doing a lot of different things, and that makes us very agile as well as equipped to handle a multitude of tax or audit or consulting or compliance engagements. Most of the CPAs that we hire have 10 or more years of experience, and they're really good at what they do and what they specialize in. So because this is considered a tax strategy session, it was also going to be tax updates, but you may or may not follow the news. There is some discussion about what's going to be in the bill that is currently being debated on the Hill, and that's changing daily, weekly, as they kind of dispute which trades. There's always horse trading that goes on in Congress, and they're trying to decide what they will give and what they will take. And so that's the tax law is anticipated to be updated, but what specific updates they're going to give, we don't really know for sure. Obviously, until it passes, and then once it goes through all of the process, it seems like they're always adjusting or changing some things. So with that, there's updates, but there's also strategies. And when strategies comes, the first kind of question we get is entity structure. So if you are starting a business and you are curious about the taxation of that business, you're going to want to know what structure should I be. If you are someone that, for example, is starting a very small company that has one thing that it's selling, if you are manufacturing, for example, makeup bags, and that's all you're doing, then you may not fall into a bucket that has a big manufacturing process or has a lot of employees or has a lot more going on. A single member LLC might be appropriate for that. And what that does is provide a liability protection screen for you because it's an LLC, which means it's limited liability, but it doesn't really complicate your tax picture. Those are pretty straightforward from a taxation perspective. It just kind of flows through onto your individual tax return. If you have employees that are earning money for you, so you have created a business that has people under you and their work is creating revenue for you, one of the things that we would suggest, or a structure we like to suggest, is an S corporation. And an S corporation allows you to, don't worry, allows you to avoid the additional employment tax on the revenue that other people are making for you. So this structure is a little bit better for if you have 5 people that are working for you and their wage is paid, but then you're making a margin on those 5 people. If you're an S corp, that margin can flow through as other income to you, which is taxed at a different rate than if you were a single member LLC. All of that income would flow through to your individual tax return and be taxed in full rates. So the S corp allows a little bit of flexibility if you have more than just you earning the wage. The C corporation, we don't do a lot of those. You know, they were always considered a bad vehicle for small business because they are multi-taxed. So the corporation itself pays a tax, and then when you take money out, you pay a tax on that distribution, which is also known as a dividend. When the Tax Act was passed in 2018, that C corp rate dropped significantly. It was actually lower than some of the individual rates. And so then there was some planning discussion about, well, maybe I would like to be a C corp because even with the double taxation, it might provide some extra benefit. But even still, I believe it's most cases not great for a small business, just because of the double layer of tax. And part of the update piece of this conversation is that they're going to increase the corporate tax back up. So a lot of people don't like to jump into C corps because it typically does have a double layer and they're always messing with the rates. So it's a little bit more difficult for a small business owner to be in that structure. Now, sole proprietor is great, and that actually probably should have been my makeup bag example because there's not a lot of risk in developing a makeup bag, so you may not need the protection that you would say like you would have over here with the single member LLC. The sole proprietor is just reported directly on your tax return. There is no separate entity. You just take the income from what you're doing and you report it on your tax return directly. Now, an attorney might tell you that you always need protection. You always need liability protection because you never know if maybe you're meeting with someone about, let's say you're a graphic artist and you accidentally run into them with your car, you would still want that liability protection that separates your business from your personal. As a tax person, I can tell you the difference between a sole proprietor and a single member LLC isn't anything. The tax ramifications are exactly the same because the federal government says this single member LLC looks just like this sole proprietor. It's called disregarded. They look the same. So from a tax perspective, it's the same. It would be more of a question of, from a legal perspective, do I need that shield that protects me from someone suing me? And in the same vein of the single member LLC, there's also a series LLC where you can stack LLCs. So if you are, for example, a restaurant franchisor and you have multiple locations or you have multiple stores, and let's say that you wanted to have managers at the stores compensated differently, and you wanted to make them a member of that LLC, but you didn't want them to be a member of the entire franchise. The series LLC allows you to break up your assets and break up your members' ownership. And similar to kind of a parent company that consolidates, they have series under them that are little pods. And it's a really great structure for someone that's doing a concept that is multiplied over and over again with the same kind of cookie cutter setup. And then there's also a partnership, and a partnership is very similar to a marriage. You have to really like the person you're going into business with. That, from a tax perspective, is treated as self-employment tax, meaning you're paying the company side and your personal side of the employment taxes. When you are an S corp or a C corp, the company is paying the company side, which technically, if you're the owner, you're still paying. But then the partnerships, the sole proprietor, single member LLC, and the series LLC, those all flow down to you and are taxed at the full employment tax rate. So there's not a lot of tax savings in those. The biggest, if you're thinking of strategy to save tax, is the S corp. But again, in the updates, they're talking about taking, the Congress likes to call it a loophole. We just call it a tax deduction, but they're looking to take that loophole away to collect more money from taxpayers. So depreciation is always a very boring concept. If you have assets that you're placing in service for your business, they are depreciated over their useful life. Here are some examples of 3, 5, 7, 10-year property, 15-year property, and then 39.5-year property is always real property. When I was in school 20 years ago, depreciation was a big deal because each asset class was treated differently. You had to track the different asset classes. They treated computers very differently than they do now. It was thought that your computer would last you a very long time, and now you just expensive write-off books. And depreciation has always kind of moved up and down how they're going to treat it. They apply different methodologies and they change asset classes all the time. Currently, you can write off all of your fixed property or all of your this category 3, 5, 7, 10, 15-year property in the first year. 39.5-year property, which is real property, you don't depreciate anyway. Well, I'm sorry, land you don't. 39.5-year property like buildings will still be 39.5 years. So this isn't really that informative, I guess, because asset classes, even though there are classes, most people just write them all off. Now, when you go, say for example, you're a graphic designer and you have, I keep using that one just because it's an easy one, but you have equipment and you know, iPads and software and everything that goes into creating your product, and you expense all of that, and then 2 years later you close your business. If you don't sell all of those assets, you do have some recapture issues where you took, well, if you do sell them, you still have to recapture, but basically the government says if you're gonna write off all of this equipment in the first year, and then you're gonna close your business the second year, you need to pay us, because you took a deduction that should have been 3, 5, 7, or 10 years, you took it in the first year, and you took that off your ordinary income, and so now we have to kind of true that up. So there is a recapture issue when you're selling your business. Now, if you continue to pursue the endeavor, that write-off lasts that first year, and you move forward as if it's just a business expense. I have a real-life example of how great this has worked out for one of my clients. They are selling out of a position they've been invested in since 1985 with a lot of assets, and the sales price is $50 million. So they're selling their assets for $50 million, and then the people they're selling their assets to want them to buy back in. So they're going to get a $50 million check coming their way, which is taxable, the capital gains rates, long-term capital gains rates. We're going to have to do some recapture on some of the depreciable assets that they're selling. But then when they buy back into the new partnership, the $50 million that just was paid for these assets is going to be 100% written off. So now they're going to get the money that they paid completely written off through their K1, and it nets out to be a very favorable tax position for them. And that's only going to be able to happen in this year because the current administration is trying to do undo all of these things. So it's actually a really great deal for my client. What is not deductible? Just make sure I haven't skipped anything for you here. So meals and entertainment, there again is always one that is fluctuating as far as how the law is written and how they're going to treat it. That's kind of misleading that it's not deductible. Entertainment is not deductible, but meals can be if you're having company meals on site with your clients. I'm sorry, with your employees, not your clients. You can deduct the meals 100%. If you're with a client conducting business, you can deduct the meals 100%. It used to be 50%, and then there's there's so many acts that have come out in the last 6 months that I have to, well, last 2 years really since COVID, that I have to write them all down. The Consolidated Appropriations Act that we just call CAA, and all I know it is CAA, so I have to write down that it's actually the Consolidated Appropriations Act, to help restaurants change the meals from 50% deductible to 100% deductible to try to help people go patronize restaurants. So that is a small change under non-deductibles. Fines and penalties are obviously not deductible. Political contributions are not. Gifts to anyone over $25 is not. Now, one thing you can do here is if you are giving gifts to your client and you are spending more than 25, there is the ability to put your logo on something, which is why you see squish balls and everything else, that if you put your logo on it, it can be classified as advertising. And that's one of the things that we were talking about when the new tax law took away this entertainment piece, and everyone had season tickets to the Texans games and the Rockets games, and now they cannot deduct entertainment. Well, maybe if on their box they had their company logo across the front of it, they could get partial advertising and partial entertainment and get some sort of deduction. So there are some things you can do with gifts over 25. If you gave your client a big, $200 Yeti cooler, but it had your logo on it, then you could say, well, it's advertising. So there's some things you can do there. Country club dues are not deductible, obviously personal expenses. This one's actually pretty comical. The things we will get that come through our office where it's, someone's running some store in a shopping center in the Woodlands, and then on the credit card charges, you will see the spa, Louis Vuitton, and you call and you say, I don't think this has anything to do with selling donuts. And oh, that's my wife. She just used the wrong card. So obviously personal expenses are not, but it's pretty common to kind of commingle, especially if you're a small business. And then anything illegal. And shockingly that happens. I've had a client come in my office, one of my favorite stories. He said, you're like an attorney, right? Anything I tell you, you cannot tell anyone else. And I said, it's almost exactly the same. And my husband's an attorney, and I feel like I've said this 1,000 times. I am almost bound to the exact same rules as him, unless I get subpoenaed. And I have been subpoenaed. And when I'm subpoenaed and they say, did your client know X, Y, Z, I am compelled to answer. Under oath, I have to answer. That's the only difference. So he says, okay, I think I'm okay with that. I made $1 million last year that I don't want the IRS to know about. So what can we do? And I said, well, you can leave. Because this is not the place for you. But it happens. There are people that are doing illegal activities and they're hiding it from the IRS, even right here in your own hometown. I was like, don't say another word, because then you're going to have to get involved. Just stop talking. So benefits. Kind of make sure we're still on. Benefits are a great way to keep employees. And I don't know if everyone's aware there's a little labor shortage. And so providing benefits to employees obviously is one incentive to keep them in your office or to keep them from leaving. These are just kind of some basic ones. The 401k, I'm sure everyone is aware, you contribute through your company, it goes through your paycheck. Sometimes companies match, and it's not taxable, and then it's deferred until you retire and you start taking the distributions. Deferred compensation works very similar, except it's through options. Typically a publicly traded company can give you stock options, deferred compensation through ISOs and different stock incentives or incentive plans. And then the traditional IRA, depending on if you meet the hurdles, you can deduct the contribution up front and against your current year tax return. And then once you start taking the distributions on the gains, you'll pay tax at those rates. The SEPAR IRA is one that we advise pretty frequently because a lot of our clients are self-employed and they want to get into a retirement plan, but they don't work for a big company. So SEP IRA allows you to put money away for retirement based on your self-employment income. There's some limits on that as well. The Roth IRA is also one that Congress is looking at adjusting in the latest bill package. The Roth allows you to pay the tax now and defer the income or not pay the tax later. And one example I saw, I believe it's one of the PayPal co-founders, has $5 billion in a Roth. And one of the things they're trying to do is take people like that and say, you can't have $5 billion tax-free coming to you. So what happens is you put the money into the Roth, which is it's a limited amount. And then if he invested in PayPal that whole time, he's made $5 billion in gains, and then he tries to take it out and there's no tax. And so I have to use the term loosely when the government says the rich need to pay their fair share. It's those kinds of examples that they're looking to try to claw some of that money back. So the Roth is one of the things they're looking at changing, but it's for very high net wealth people that they're going to try to change that. Updates. So when I was told I needed to turn this presentation in, they were still debating what they were going to do in the it pains me to say build back better plan. I just don't like that phrase for some reason. The things that I wrote here, which you're not gonna be able to see because those are question marks, and I apologize because I didn't know what to put on there because everything kept changing. It went from 3.5 trillion to now it's 1.4 trillion, and we're gonna get this and that, and it's gonna pay for itself, and no, it's not. And so just some highlights for the people in the room that might be affected by the changes in the tax law is the increase in corporate tax rate from 21 to 26.5. That's currently being discussed. A surcharge on anyone earning more than 10 million. So basically they say if you make 10 million, now we're gonna slap on another 8% that you need to pay. And the S Corp, all of that planning I told you about with the S Corp where you can avoid employment taxes, they're gonna close that loophole and apply 3.8. Well, the employment taxes will stay the same, but they're also gonna apply the 3.8 net investment income tax on S Corp income, which again, like I said, would flow through to the K1 and you report it on a different part of your personal tax return, and it kind of avoids a lot of the additional layers of tax from employment and or investment tax, but they're looking to change that too. Capital gains tax for long-term capital gains will go up to 25% from 20. The top individual rate will be 39.6. And then for people earning over more than $1 million, married, filing joint, your long-term capital gains and your dividends will be taxed as ordinary. That's kind of a big one. They've never done that before. And then they're looking to remove the step-up basis in death. So for example, if my parents died and they left me stock, I just inherit their stock and I get a step-up in basis, which means if they handed me Apple stock on their date of death that was worth $50, then I have a basis of $50. If they bought it at $5, that $45 gain is not taxable to me because I stepped up to 50 and I have no gain. Well, they're looking to remove that and say that when I inherit that $50 of stock, I have to pay the gain on the 45. They're also looking at lowering the estate exclusion. That number keeps getting changed. They're also looking at changing trusts and how they're currently outside of the estate, certain types of them. They're looking at bringing them into the taxable estate. Another one that is a popular one with our clients is the 1231 exchange. So originally you could exchange property and defer gain. And it was any kind of property. And then it changed to just real property. So if you had a farm in Iowa and you wanted to buy a farm in Montana, you could sell your family farm and take the $1 million gain, put it in your farm in Montana and just bypass any tax until you sell the Montana farm. Now they're wanting to change that to a $500,000 limit. So if you had, and this actually happened to my client, they had it was like 3-generation farm and they made $3 million off of it, their piece, because each kid got a piece. And then they bought another farm and they just put that $3 million into that farm. With the new law, they would only be allowed to exclude the $500,000. The $2.5 million would be a taxable gain upon the sale of that ranch. They're also looking to tax carried interest as ordinary income, which I know has been a long-term contentious debate. I think I've actually gotten a debate with Tim Lovis on that at one point. He's a staunch supporter of taxing carried interest as ordinary income. And as a neutral party, I'll not tell you my opinion. And then they're looking to, I liked this in our little update, it was just a little sentence. Looking to repeal credits and deductions for the fossil fuel industry. So that's about as non-specific as you can get to say that we're going to punish oil and gas, but they're going to try to make some changes in that area as well. And then another area they're looking to change is the QBI. Again, everything in our world is an acronym. It's the Qualified Business Income is what the QBI stands for. This has been great for so many of our clients because you can take up to 20% of your qualified business income and exclude it from your taxable income. So if you fall in this little area, single taxpayers with taxable income under 157 and married taxpayers with income under 315, you can take a 20% deduction just straight off of your tax return. It's just not even taxable. Now, the way you qualify that is qualify for that is under 199A, which means you're basically producing something. So it was in my opinion, a great way to incentivize us to manufacture in the US. So if you are producing something, whether it's pencils or plastic bags, if you're producing something in a facility, manufacturing something, then you could qualify for this qualified business income deduction. Now, when this was going through Congress, they carved out services. And their big example was that they didn't want the NBA basketball players to just carve 20% out because they're not producing anything. It's just a service. And they also, with that definition, took out attorneys, accountants, doctors, insurance. But the interesting thing, and I just feel like I would be doing you a disservice if I didn't talk about how it really goes on in Washington. The interesting thing about it is they did pick some service industries that were winners. Architects got it, some bankers got it, and I do believe there was one other service. You're shaking your head like you know. There's one other service I can't think of, but it started to look like they were picking the people that maybe contributed to their campaigns or maybe had some skin in the game, because there was not really a rhyme or reason to how some service industries were selected and some service industries were excluded. And that's just my personal sidebar, because it started out with no service at all, and then suddenly a couple of services were allowed to take the deduction. And it's kind of a convoluted calculation. So you start with the 20%, and then you say you can take the lesser of the greater of. And by greater of, you mean these two, and by lesser of 20% or this. So once you find the greater of this, 50% of wages or 25% of wages plus 2.5 of your unadjusted basis of property, which is really great for someone who has a lot of capital. They have a lot of buildings, and their basis in the property is in the millions, and they pay wages. This will provide a good deduction for them up to 20%. So you take the greater of these two, and then if it's more than 20%, you're just capped at 20. And if it's less than, then you would take the 20. Very complicated. They're looking at changing this because they gave away too much money, I think. So the CARES Act, it's funny because this was open when we drafted the slides, and now it's closed. The employee retention credit is still open. I'm sure everyone, well, maybe I shouldn't assume that. I'm assuming everyone here has heard of the Paycheck Protection for the PPP. And the SBA idle loans, those are both closed. But we have processed more than I can count in our office for those, and it was greatly needed by so many of our small businesses in the area, our big businesses too. So the employee retention credit is a refundable credit against certain employment taxes that's equal to 50% of your qualified wages paid after March 12th, 2020 and before January 1st, 2021. Lots of our restaurant clients have received a lot of money out of this credit, because you have the hurdles you have to meet. You had to have been shut down by the government. You had to have significantly dropped in revenue from 2019 to 2020. And then you have to pay a lot of wages because it's a refund of your employment taxes. So we had a lot of restaurants that did well with that. And we have a little disclaimer here. Many credits have expired. Please reach out to your CPA because this one has now expired. Now, before I go back to that, or go to the next slide. No, I'm going to go to the next slide. I'll come back to what I was going to say. So the tax filing timeline, they just recently, I guess in the last year or two, changed some of the dates. It's starting to get a little convoluted because they keep pushing them. So you have a tax day flood, and all of a sudden now you're doing June, and then you have Harvey, and now you're doing August, and then you have coronavirus, now you're doing July. In my office, we just like to have a regular year where they don't change the dates. I was on a vacation with my family in July because it's literally the only month there isn't a tax filing until we had COVID, and then everything was due in July, and everyone in my office hated me because I wasn't there. So where we start in January, your W-2s, your 1099s, 1098s, and your fourth quarter, if you're making estimated quarterly payments, are in January. February, we just put forms because there's a lot of different forms there that are employer forms that kind of irrelevant. March, your 1065 and 1120S, this would be your S corp filing, is due in March, and your partnership return. And then in April, everyone's favorite month, the 1120, the 1040, any estate return, or I'm sorry, trust returns, and then your first quarter estimated tax payment. And then in May is when we do all of our nonprofit work, our 990 and foundation work, and then Texas is filing. And then we extend everyone else, and all the extension dates follow. Before I talk about that, what I was going to circle back to is when I said I felt like I would be doing you a disservice if I didn't tell you how everything goes on in Washington. I also feel the need to tell you how much your tax dollars total. So there's a discussion right now that we're in a massive deficit. We keep building more and more debt. And so we need people to pay their fair share. There are arguments being made that people like Jeff Bezos or the guy I talked about that had $5 billion in an Roth IRA are not paying what they should. And then there's arguments that people in this room are not paying what they should. I like to point out the counter argument to that because I don't think it gets talked about very much. You can find this on the government, any government website that is connected to the Department of Treasury. But I do find it to be very interesting and I feel like it needs to be mentioned more. So in the spirit of educating, I would like to educate you that in 2018, the total revenue collected by the Department of Treasury was $3.3 trillion. In 2019, it was $3.46 trillion. That's an increase. In 2020, the year of COVID, it was $3.7 trillion. And in 2021, it is estimated to be $3.8 trillion. Now, the reason why it's important to point that out is those are all records. The year before was the highest, the year before was the highest, the year before. So we are setting a record at $3.8 trillion, according to the government's website, in dollars collected. So I would submit that maybe we have a spending problem and not a revenue problem. I mean, in my house, if I said we're getting a raise every year and we still can't pay our bills, well, maybe it's the bills. And again, not to get political, I just think it's factual that if the Department of Treasury is continuing to collect more dollars from its taxpayers and still saying we aren't paying our fair share, I think it's important to talk about the spending side as well. So if anyone's bringing that up to you when you are talking about taxes, you might have that little nugget handy that we are setting record revenue collection. Recession numbers were down. If you go back and look at 08, 09, there's a dip, and obviously anytime there's a recession, GDP contracts and taxes contract. But when people will tell you that the tax job, I actually just heard it from a congressional candidate the other day, that the law that Kevin Brady helped champion and pass doesn't help us pay our bills. Actually, that's it's misleading because the dollars collected have gone up, which means it is helping us pay our bills. It's that the expenses have to. So just kind of food for thought. And then when do you see a CPA? This is kind of like a picture of all the things that we do. We have a lot of food and beverage clients. We have a lot of energy clients, given that we are in Houston, construction and banking, healthcare, because we kind of have a great little healthcare center economy up here right in the Woodlands. Not-for-profits, and then we're always dealing with people that are investing in different ventures in real estate. I don't really have an answer when you see a CPA. I think it's just when you don't know the answer and you need some guidance. This is our contact page that kind of tells you how to get a hold of us, but we are happy to help with any questions and any issues that anyone needs a CPA, comes to us and wants to talk about. I can tell you sometimes we're not the greatest fit. If we have foreign issues we're dealing with, tariffs or treaties or things that are dealing with other countries, that's not in our wheelhouse. We refer that out to international tax CPA. Or if you're dealing with, maybe you have just 2 or 3 questions and we're kind of built to be a bigger, robust, we can do your bookkeeping, we can do your payroll taxes, we can do your quarterly filings and all of these things. You just say, well, I just need like 5 questions answered. We can do that, but I kind of like to caveat that by saying, we don't want to ever make someone feel like they didn't get what they were paying for, or it wasn't a good fit, and we end up on different sides of what we thought the communication was. So how we typically make sure that doesn't happen is we have you call the office, set up a consultation, and we kind of talk about, these are the things we do, this is our price sheet, kind of tells you what you're looking at, and this is how we operate, this is how we bill. And that way, you're not jumping in. It's kind of like medical billing. I don't really want to go get the procedure and then find out later it cost me 4 times what I thought it was going to cost. So we try to communicate that up front, that this is kind of the bullet point items that we typically see and what it typically costs, and it's just called our fee sheet. So we provide that to everyone that is interested in coming in and getting some more information. Again, this is a very broad overview of kind of some strategies and updates. It gets very specific when you're talking about final thought. Getting voters to vote for politicians often involves some promises. So one of the things in this bill is that if you're under $400,000 in AGI, your taxes will not go up. Now, why do they do that? They do that because they're targeting specific voting blocks to say, I really need this base to stick with me and I don't want to increase their taxes. Now, an alternative argument is they really care for these people and they want to make sure that they don't tax them too much. But I tend to believe it's because that's a good voting block. And, you know, if you say the wealthiest 1%, you're really talking about 1% of the voters too. So you don't necessarily need that 1%. You need all of these other people. So that's how you end up with these carved up tax laws. But if you're married filing joint, you make $400,000 a year, your tax rate is this. But if you're married filing joint, you make $200,000, it's this. And if you're married filing joint, you make over $1 million, then all this other stuff kicks in. So I say that to say, whatever I'm saying here may not be applicable to you, or may not be applicable to you, because you might not fall in this perfectly carved out little subsection. So that might be another reason why you want to see a CPA, is just to kind of understand, is this, all of these changes, how are they impacting me specifically in my specific picture, because it's not a cookie cutter blanket resolution for everyone. So I think we have like 5 minutes for questions.
I have one.
Yes,
You
ma'am.
mentioned about the gifts, and I took that as gifts out.
Yes.
What about gifts to your staff, like over the Christmas period? We always give gifts at the Christmas party.
I believe it's a similar deduction. I don't know the cap off the top of my head, because there is a cap that it then becomes a wage and you have to report it on their W-2. So once you've compensated them above, and it probably is the 25, you're entitled. Don't hold me to that.
Don't buy much.
Don't hold me to that. There is a cap, because you wouldn't be able to say, I'm gonna gift you $1,000, because they would say that's a bonus that's subject to Social Security and Medicare. So they don't want you to avoid taxes that way. So there is a cap. I don't know the cap for employee gifts off the top of my head, but there is a cap. But employee holiday parties, that's considered meals for your employees. Parties, picnics, team building stuff, so you can deduct those things as
So
well.
we need to be careful if we're giving gift cards for a Christmas stocking stuff.
You do, but here's the thing, I have clients that do it all the time.
I was gonna say, we've done it for years.
All the time, and the
I didn't know that.
yeah, and technically, at some point,
I'm
it
not telling
costs.
anybody.
No.
This is for a grant of time.
Now, and technically, once you cross,
Yeah.
once you cross there is a cap, and I'm sorry, I don't know it off the top of my head. Then technically, it should be reported on their W-2 as compensation. And that is just, again, if we have a law, it's because at some point someone took advantage of it. And so that is because people were gifting things like cars
Yeah.
or country club dues, or they're gifting these things and saying it's a gift, but really you're compensating that person for their job. So I would, if I were your CPA and you had spent $150 on your employees, I probably wouldn't ask you about it. But this is being recorded. Any other questions?
Well, what about recapture of real estate? Is there a way to kind of offset against that?
Through the 1031 exchange, there is. And then if you're selling your private home, if it's your personal residence, then there's an exclusion on that gain too. It's up to $500,000 for married couples. So if it's your primary residence and you're selling it for a gain, you don't recognize up to $500,000 if you're married, $250,000 if you're single. Is that what kind of real estate you're talking about?
No, I was talking about rental.
Rental real estate, the only way to defer a gain on that is, that what you mean? To avoid paying the gain on the sale, is to buy another, put that money into another rental property.
Just to do an exchange.
Yes.
That's-
And that's, yeah, and that's a whole process. There's lots of firms around here that do, that's all they do. And then like I said, the update on the Hill is they're gonna exclude or cap that at $500,000. So if you sell it for a $600,000 gain and then you roll it into another property, you'll have $100,000 you'll have to recognize then, but the 500 can get pushed.
And what about major structural repairs and so on?
So I typically advise my client that if you can't move it, like I can move the table, I can move the whiteboard, but I can't take the sheetrock with me, then that's just an increase in your basis. So if you paid $10 for the structure and you added $5 of sheetrock, your basis is now 15. So when you sell it, your purchase price is 15, not the 10. But if you're putting in a dishwasher, microwave, light fixtures, things that you can take out, I would classify those as repairs.
Like the siding, the roof, and all the rest of it.
Yeah, you're not gonna take the shingles with you, you're not gonna take the flooring, but if you do new light fixtures, new appliances, anything that you can physically take out with you. Obviously they're screwed to the wall, but you can take them off of the structure and walk out. Then we can classify those as repairs.
I was just interested because my CPA keeps track of, all this stuff. And I think if you're in real estate, you really do need the CPA.
Yeah, absolutely, yes.
What advice do you give people who are sitting here November 5th and trying to budget for 2022? And what tax liabilities they might have, either individually or as a business? So, did you want him to answer that question?
That was not planted, believe it or
Objection,
not.
that's leading.
That was not planted. I've been doing this for so long that I feel like the answer is the same. I don't have a crystal ball. I can tell you what I think they're gonna do. I can tell you based on this administration and based on the track record they've shown us so far on what their agenda is, that they're gonna try to tax you more. So I think, and unfortunately, I feel like I've deviated probably 2 or 3 times down the political path in this conversation, but unfortunately, taxes are tied to politics. In my graduate tax class, we had to debate all the different ways you could tax: a flat tax, a VAT tax, a sales tax. And I was debating the flat tax as being very fair because every single person has some skin in the game. If every single person is paying 10%, if you're making 6,000, you're paying 10. If you're making 6 million, you're paying 10. Everyone is having to fork over something for the use of the roads and the military and everything else. And I thought my points were very valid and strong. And my professor, who was in the back where you're sitting, says, it will never happen because you can't buy votes with a flat tax. You can't promise things to anyone with a flat tax. And you're never gonna, and the same reason we don't have term limits, you're not gonna get someone into the office and say, well, let's take away all of our ability to tell our constituents we're gonna do something for them. So the way this administration has shown where it's headed, I think the taxes are gonna go up. They have to, at some point, they've spent and printed so much money that the deficit's so bad right now that I feel like that's just inevitable. Now, the sticking points, and you know this, we have clients that have participated in major sale events this year, major. One was $1 billion, the one I just talked about, that was 50 million. And they're closing these deals very quickly because they were trying to make the capital gains tax retroactive. So if you sold your company in May for $1 billion, and let's just say for, hypothetical fantasy, you gave every family member and every alma mater and every church you love all your money. You had nothing left. And then they retroactively tax you. You have to come up with 25% of that $1 billion when you're out of cash. You've already spent it all, which is the most unfair thing to do, I think, is just to change the rules after you've already played the game. And that has gotten a lot of traction, at least with Manchin in West Virginia, that he's like, I'm not voting for it, because it's just not fair to the person who was not prepared for that to be coming at them. Because once I had the cash, I could have carved out the taxes and set it aside and then given all my money away. But to change it after the fact is pretty hard to plan for, obviously. So to answer your question, I think they are going to raise taxes. I think you should be prepared for that. But smart people always find a way to do their best to pay the least amount as possible. And there's actually case law, Supreme Court case law, that says you are entitled not to pay $1 more than you owe. So there's nothing wrong with trying to reduce your tax burden. And that's why we have a job. So I don't have a specific answer, just be ready to pay more taxes.
Real quick, the transfer of stock,
Yes.
that people inherit. Do you pay the capital gains at the date you inherit it, or is it when you sell it?
When you sell it.
So it's just your basis doesn't.
It's just you inherit that basis.
So you inherit the old basis.
No, you inherit the day of. So it's called a step up. So you get a step up that this is my basis and I'm not paying on the gain.
Okay. You said they're changing it.
They're changing it. Yes, to where you're paying it the day they die.
Oh, you have, to okay, that makes sense.
Yeah, they're wanting to collect, we're doing a lot with estate tax, which is easy to do because the people that would complain about it are dead.
Yeah.
So they're doing a lot to tax more of an estate, to get more out of the estate tax.
State taxes are really fun too. 'Cause
Yeah.
You're in the midst of everybody arguing.
Yes, exactly, exactly.
They should, yeah. there's a
Thank
family
you.
aspect.
I appreciate it.